Hello again, everyone. Hope you enjoyed the break, and I hope you enjoyed the first panel. Thanks again to all the speakers on that. We certainly brought up a lot of interesting topics, and there's lots that we can pick up on in this second panel as part of this Team Europe Borrowing Day today. One of the things we're very proud of at OMFIF is our ability to bring different sides of the market together. So having started with a panel of issuers and intermediaries, now we have a panel of issuers and investors. And we have a very, very stellar lineup of people with us to join us for this second part of the conversation. So I'll just quickly let you know who's with us. We have Pablo de Ramón Laca Clausen, who's the Director General of the Tesoro Público in Spain, who has just issued, as you would have heard earlier, his debut green bond to much success, which we will discuss. We have Agnès Belash, who is Managing Director and Chief European Strategist at the Barings Investment Institute. We have Sevinch Akar, who is Investment Director for Fixed Income at PGGM. We have Elena Panamarenko, who is Head of Funding for Europe at the IFC Treasury. And we have Christian Koch, who is the Managing Director, CEO of Fixed Income and FX at Union Investments. We talked earlier, of course, about the transformative effect that the NextGen EU may be having on European capital markets. And I'd like to start by asking the investors how they are viewing NextGen EU, Team Europe, and the development of the Euro capital markets in the 3 or 4 months since this NextGen EU program starting. And I'm sure the other panelists will forgive me if I go to Agnès first, because Agnès is not just an investor now, but of course has experience from working as a senior official at the ESM before. So as on the funding side. So Agnès, over to you to kick off this discussion, please.
Okay, so thank you, Clive, and hello, everybody. It's a pleasure to be here. It was a great session previously. I listened to most of it. I think I'd like to add maybe a little bit of a different perspective. We all agree that NGEU bonds are symbolic, they are inspiring, they are full of promises. There have been a long-awaited historical innovation in the EU. But this is why also it's so important that they hold the right place in investors' portfolio, in private investors' portfolio. And I'd like to bring to your attention, if I may, a few missing ingredients. The first one is that it's very difficult for private investors to figure out the nature of these instruments. Are they supranational debt instruments or are they sovereign ones? And why is there such a doubt? You know, there are really two reasons. The first one is that bond investors need to know what to price them against. And when you have, supranational, you tend to look at the EIB, the other EU issuer. You tend to look at a really good supranational, that's German, KfW. But you also have a choice to compare them with French OATs, with German bonds, and even Austrian bonds sometimes as well. So why is there a doubt? Well, most of the time, I mean, all the time really, supranationals so far issue in small amounts. They issue 3 to 5 billion per issuance, and they have an issuance program of about 30 to 50, maybe 60 billion a year. But NextGen EU issues triple that amount, or closer to 10 billion in issuance, and the funding program per year is 150 billion. This year was 80 because it started in the second half or in the summer, but this is a massive issuance program. So this doesn't tick like a sovereign, like a supranational issuer. And the issue is that the communication program must be really, really clear, because when there are such a mountain of issuances, investors need to know what's going to happen to the curve and the bonds they might be already holding. And for example, before the summer, there were 45 billion of NextGen EU bonds that were issued in the space of 4 weeks. So imagine what that did to the curve and how those investors that were already holding those bonds lost money and we're rather concerned about this type of experience. So I would say communication policy and managing expectations are really, really key in such a different type of supranational. The second thing that's a little bit different is that normally supranationals issue only through syndication. But NextGen EU has announced already a few auctions. In the case of the ESM at the time, it was the middle of the crisis, and it had the ESM, as I remember, needed to show that it was a very strong issuer, close to sovereign issuers in that ballpark. But NextGen EU is not in the middle of the crisis, and rates are close to zero, if not negative, for most of its issuance curve. And it's not clear why it wants to look like a sovereign. So investors, it gives second thoughts to investors. What is going on? What are they trying to tell us? And of course, I'm saying all this because as I said initially, the question that investors have is how to price them. So you might think it doesn't matter if they have to be, the nature of these bonds have to be those of a supranational or that of a government, right? What does it matter? Because what matters is really the return. But what I was hinting at is that you need to be able to assess the return. NextGen EU bonds are not a benchmark yet, so they have to be compared to other bonds. And, the question really is in investors' mind, and we talk about it among ourselves all the time, are they a very expensive supranational or are they a cheap sovereign? So every investor going into this market will have his own theory of change. What's going to happen for these bonds to perform? When they come to the market, they are priced relative to mid-swaps. And what that means is that usually it's good practice for some investors to hedge the interest rate risk on those bonds by switching the fixed rate for floating rate. And therefore, the mid-swap, the spread to mid-swap tells you how much it costs to do that. But that's not the case for NextGen EU bonds because the coupon is zero and the interest rate is negative. So you don't really need to hedge it. You don't naturally need to hedge it. So when this comes to the market, what private investors immediately do is look at the Bunds curve, the OAT curve, and the KfW curve. And then it looks quite expensive as well compared to the French curve. It looks quite expensive compared to KfW curve, and of course the EIB curve. So investors are not completely convinced about buying those bonds. And if the theory of change that they have in mind is this is the next safe asset and they will converge to Bunds, then they compare the yield or the return offered on these bonds with BTPs or even Spanish bonds, which at least pay a positive return at some maturities, at least. Above zero is quite important nowadays. So I think I just wanted to bring to your attention this little confusion that could be clarified somehow, or maybe resolved by not pricing so tight to the French curve or so tight to other supranationals, to give investors the idea that they can benefit entering these bonds, hold them in their portfolios, and have sort of a demonstration effect as this program is unrolled. There are only 4 bonds so far. That this is a cool investment to have in your portfolio, and that you don't risk having this oversupply without caution, selling off your investment and you losing money. So that was my contribution, my first contribution so far, Clive.
And you kick us off in a very strong way and raise a lot of important issues. Just before I come to the others, from what you said, some of the challenges you bring up there, does that mean you're not buying these bonds, or are you still buying them?
No, at this stage, I think that the curve is too volatile and the return is not high enough, in very good conditions on the European market right now. So no.
Okay. Thank you. And you obviously clearly see the NextGen EU and the EU as a supranational rather than a sovereign, from what you were saying, I said.
Yeah, so far that's what they are. Yes.
Okay, thank you. Sevinch, I wonder whether you have similar concerns and similar thoughts to Agnes.
Well, first of all, thank you, Clive, for this wonderful panel, and also thank you for my fellow panelists. Well, I heard an echo, so I completely agree with Agnes, but I would like to give also the Dutch perspective from the pension fund side, from the short-term and from the long-term perspective. From the short-term perspective, it was attractive to invest in those bonds. Because it next to that yield, and also it offered also diversification in our portfolios. But however, in the long run, we need also curve, for because ultimately we are long-term investors, and we don't. Well, for us, is it a one-off thing or is it permanently? And then we are hearing different views within the European space, within the European Central Bank space, for instance, from the German Central Bank. well, also the from the Dutch angle, the Dutch central bank or regulator requires a buffer capital on EU bonds. And this is not the case for the other AAA sovereign bonds within Europe, like the Dutch government bonds or the German government bonds. So there is no exception at this stage on this category of these bonds. And because there are non-AAA European countries providing guarantee for this bond as well. So that's why our regulator doesn't requires a buffer capital. And on the long term, do I see this as a reference bond? For us, is the German government, the Europe's fixed income instrument, only in an environment where you have a complete fiscal integration within the European. This bond could be a reference bond, but in my opinion, this is a bridge too far. For this reason, we see the German government as ultimately as risk-free bond in our portfolio. Yes, to conclude, yes, in the short run, it offers value, it offers diversification, but in the long term, I have got my doubts because maybe it's a one-off thing. Thank you.
Thank you, Sevinch. And some of these issues, I think we'll bring in a little later on some of the intermediaries because they can talk a little bit about the pricing aspects and the reference aspects. I'm sure Niall's ears will be burning if he's still listening to this a little bit, and be interesting to hear what he has to say afterwards. Christian, your take on what Agnes and Sevinch have kicked off here in terms of the attractiveness of these bonds and your view as an investor of what happened so far.
Yes, Clive, thank you very much. I think Agnes has brought up the key point when we discuss Next Generation EU, which is what kind of an animal is this? Is this an agency or is it a new sovereign? Are we witnessing the birth of a new sovereign here? And I'm taking a less philosophical approach to this, a more practical approach, and that it is just too big for an agency. The issuance size is massive. And this actually is one of the key reasons why we find the new Next Generation EU bonds attractive relative to other opportunities in the market. So I'm not saying that, overall yields are attractive for private investors. Here, they're negative in real terms, negative sometimes in nominal terms. But relative to the other stuff out there, I think Next Generation EU is very attractive because it is becoming a highly liquid issuer compared to EIB, ESM, EFSF, and the like, with almost the same yields, but with significantly higher liquidity. So to give you an example here, the Next Generation EU bond, July 2031, trades at mid-swaps -15 and has 20 billion outstanding. The EIB March 2031 is a 3 billion bond and it trades at mid-swaps plus -14. ESM is a 4 billion bond, trades at mid-swaps -10. And the EFSF 2032 is a 2 billion bond, 2.5 billion bond that trades at mid-swaps -12. So you have a choice between stuff that trades at, -13, -9, -12 or so, with very small issue sizes of 3 to 4 billion, or you go into the new EU bond, a 20 billion monster that trades slightly tighter, but only 1 basis point tighter, offers you plentiful liquidity, and is a very interesting instrument from a portfolio perspective. So how do we price this? Frankly, we price it off France. Yeah, I think we price it off from a relative value perspective of a large European sovereign. And you can see that at the front end of the curve, the EU bonds are trading relatively flat to France. So the EU July 2026 bond trades at mid-swaps -20. The France 2026 bonds trades at mid-swaps -23. Yeah. So at the front end of the curve, they're trading relatively tight to France. At the back end of the curve, the EU bonds are trading way through France. So 10-year sector -15 versus -5 to swaps for France, 30-year sector +9 compared to +40 for France. So at the long end of the curve, it's trading way through France. And I'm quite happy to report we've been early investors and we've massively benefited from that move because the paper was printed relatively close to France and has tightened in aggressively relative to France. So this makes it attractive to us. Now, so this is basically my main take on this. Is it an agency or is it a sovereign? I would say it's a sovereign. From purely practical perspective, the size is very big. It trades like a sovereign. It offers you liquidity, and it trades through France at the long end of the curve. And we like it a lot because of the liquidity it offers. I can say a few more words if you wish on the green bond issue, but I think you were going to talk about it later on.
Let's come back to the green bond a little bit later, Christian, because I'd like to just focus on this because I think we're at a very existential point here. What is Next Gen EU? Pablo, you're a sovereign. Do you see Next Gen EU and Team Europe as another sovereign? Do you see them as a super? Where are you pricing your bonds? What references are you taking?
Well, thanks, Clive. The question of whether Next Generation EU is sovereign can become terribly existential and political, and I don't want to go there. And just say that in the capital market, sovereign is as sovereign does, right? So there are very specific things that an issuer has to do to step into the sovereign space. Christian has said, be of a certain size, be of a certain regularity. And Next Generation EU, unlike Shore, when it jumped from back to back to having an active cash position with a view to a steady curve, predictable, regular auction program, and the milestones it is hitting very, very quickly, it is fast becoming a point in the sovereign space. I think that is fair to say, and we have to say, and yes, I take all your points about this being a work in progress, but Next Generation EU, the Commission, has done in 6 months what many of us have done in 30, maybe 40 years. So we're establishing this new issuer in volume, with regularity, with some predictability, something that investors can bank on and include in their books, which might eventually become the safe asset. So what does a sovereign do? It is a regular issuer. It combines auctions and will weigh them more towards auctions rather than syndication, but first it has to establish those points in the curve. It has to adapt to a very transparent and competitive auction system. It has to allow some kind of a maturity transformation throughout the curve, right? And primary dealership and market making commitments from the banks, from the 41 primary dealers that they have, may help to achieve that. And within the secondary market commitments, they have to have a transparent way of mandating, right? It mustn't be perceived like they are strictly SSA mandating on the basis of lead orders. It has to be a transparent system whereby banks can know what it takes in the secondary market to engage in one of their primary market transactions. So they can do all this, and they are doing all this. But there is one thing that remains, which several of us have touched upon, which is permanence. And that doesn't just depend on the Commission, how they do this. That depends on the Commission, on member states, and European society as a whole. I have to say that as yet, it is a temporary mechanism, but knowing Europe as we all do, it may become permanent if it is seen as useful. So it is a big challenge for us all to use the investments, to enact the reforms, to achieve that growth. And 6 years from now, it will be obvious that this could be the beginning of something rather than just an emergency measure. So it is called to be a sovereign. I think it already is close to one because they're doing the right things. The only thing separating it is the idea of permanence. That will appear soon enough, as it is shown that we are all executing according to plan. And I think that one day Spain will price its 10-year as EU plus X. And this is where we all want to go, because if we can achieve that, then international reserve managers and central banks can be, far from crowding us out, can be crowded in to the EU bond market. And it will be, the existence of more Next Generation EU bonds will actually make it easier for an investor to buy more SPGBs. And this is where we all want to get. We all want to turn we all want the euro to be the next to be stronger in the reserve management space. So it is a sovereign, but it will be more so if it is implemented correctly.
Thank you, Pablo. And we'll get back, I think, to the safe asset reserve currency status thing in due course over this discussion. I know you said you would price to EU plus, maybe one day even EU minus, Pablo, who knows? So let me just come to Elena quickly now. Elena, you obviously very much at ARC a supranational. Can I quickly ask you where you see NextGen EU and the EU as a borrower, whether you see them as a peer of yours in the supranational space, or whether you see them as a sovereign, and also your initial thoughts on how the euro as a currency of funding opportunity may be changing for you, who can issue in any currency anywhere pretty much, with the developments that we've seen in the last few months.
Thank you, Clive. So IFC is a supranational institution, as you have mentioned, but a global institution. And our main business is to invest and support private sector development in emerging markets and developing economies. So what I'm trying to say, we're not actually investing in businesses in Europe. So there is very little lending that actually happening in Europe itself. As a Next Generation EU and previously as SURE issuance came through, there was definitely a discussion within the supranational community to what extent what it is and how you compare a general supranational issuance versus EU issuance. And the general agreement is really it's different. It's really different. In this regard, I would like to support what Christian has said, what Pablo has said. It's generally viewed within the supranational as more of an equivalent of a sovereign issuance rather than supranational issuance. With regards to EU becoming a currency of choice for issuers that are based outside of Europe, one of the things that I'd like to mention is there are different factors that come into play when an issuer like IFC, that's based outside of the EU, decides in which currency to issue. We're active issuer of green and social bonds. We have issued, for example, actively in US dollars, in SEK, in Swedish krona, the green and social bonds. In that regard, I'd like to differentiate between the geography of the investors and the currency in which we issue. So there are multiple considerations that an issuer will take into consideration. So there's a pool of investors, you look at your lending book size and the currencies, diversification of your funding program, the size of the program, the currency of denomination of your balance sheet, the cross currency, since you may need to swap back into the currency of denomination, how you manage the liquidity and potential negative carry. Those are just to name a few. So in that regard, when IFC decides what to issue, we take all of this into consideration. We're a US dollar-based institution. The cross-currency basis plays a significant role for us. And we also do not have a size of the funding program not even close to the Next Generation EU. So we generally issue about 14 billion US dollar equivalent. So it's just different ballpark. But we are focused on the currency diversification. So we issue in multiple currencies. So when an issuer funding program reaches a certain size, and the size of the assets, the green assets, reaches a certain size as well, so there is unavoidable for an issuer to start seriously considering issuing in euros to the European investors, because it is the largest pool of green investors. So when considering all those factors that I have mentioned, at some point, at this particular point of time, if you want to issue in size, you want to have the currency diversification, you want to have investor diversification, you have enough of the green assets, you will likely need to come and issue in euros.
Okay, then we look forward to that happening soon, hopefully. And as I say, we'll come and talk a little bit more about the green market in due course. I just want to go back to Agnes now. Some of your fellow panelists took some of your points on board, but didn't necessarily agree with you on certain points. I wonder whether they convinced you otherwise.
Well, of course, they made excellent points, but I think the issue is that there is something we would like, which is that it is a sovereign, it's a benchmark, and then there is how to get there. And I think both Pablo and Christian talked about that as well. You know, how to get there is clear communication, good management of the funding schedule. As I said, when they came up with 45 billion pre-summer, that was not what was communicated. It was supposed to be 15 billion per month. So good communication, care of investors. I mean, investors that are going to this completely new instrument, even though there is an ESM predecessor, which is a great asset per se, it's a different animal again. So you want to attract investors, you want to make these bonds sexy, you want people to talk about them well and make their advertising and their marketing and say, wow, I'm so proud I own that bond, and look, I participated to X, Y, and Z. We want to be inspired. I want to be inspired. I want to hold those bonds. So I want them to be attractive. So I was, you know, I think we agreed. I think I will look at what we agreed, which is that there are a couple more things to take into consideration to get there.
Thanks, Agnes. Pablo, just coming back to what Agnes was talking about in terms of communication. Obviously, this new, whatever it is, it's a very big issuer. It's issuing in the market in which you issue the majority of your bonds. Do you feel as a sovereign within the Eurozone that the coordination has been what it should be, the communication is? Do you worry about potentially being crowded out here? Or do you think, no, this is great because we're getting a whole new potential investor base, global investor base into the Eurozone that we didn't have before?
Well, first of all, coordination has existed with the member states. There are many fora, and I chair one of them, in which the DMOs talk, and the Commission is there, and the dialogue is constant. You'll have noticed, and it is no coincidence, that they started to issue the amounts that Agnes is saying in the summer precisely during the season that other sovereigns begin to slow down, because we pre-fund especially the first half of the year, and as we try to land the plane of our funding programs into Q4, we tend to issue less. Right? And our syndications become smaller and smaller, and our auctions become smaller and smaller. And it is no coincidence that that is precisely the moment in which the EU starts to issue its green bond, and the EU starts to auction its T-bills, and the EU starts to tap existing bonds, as they will, in the auction. So there is a lot of coordination. There is also complementarity. Because, for example, the EU green bond that is about to be issued towards the end of October, they fund projects within our budget as well. So the green bond that we've just issued, the 5 billion, that will fund 5 billions worth of very high quality projects that isn't in our Next Generation EU Brussels funded program. And so this will all feed into the same machine, which is future Spanish growth. Or future growth in Europe. And so there is a complementarity between Next Generation EU and sovereigns. And as I say, if done correctly, if this can approach the safe asset and give the impression that it might eventually be a permanent thing, this can benefit us all by crowding everyone else into the EGB market, by making the euro more easily investable. So I think it's a challenge. I give it to you, Agnes, that we're not quite there yet, but we're going in the right direction. And every sign that they give is that they want to be a sovereign and that they don't want to be seen as an SSA. And the first step was jumping from the back to back, but they do have to improve, I think, their transparency and communication, but they've built in 6 months what we've all built in 30 to 40 years. So I think they have to be commended for that.
Let me ask Christian whether he agrees with Agnes, whether they maybe should be leaving a little bit more on the table for the likes of you, Christian, and whether you think that the coordination is working as well as it could.
Yeah, on the coordination, I tend to agree with both previous speakers. I agree with Agnes that coordination, it would have been nicer if the coordination had been slightly better. There were some days where syndicated bonds hit the market where I said, whoops, that was a lot of size. We didn't quite expect that, yeah. There was an element of lack of coordination between EFSF issuance and EU issuance. But, then again, Siegfried Ruhl had to pre-fund, I think 13% or so. So he just had to pump some paper into the market. And I also think that now with the issuance calendars that are being made available, with T-bill issuance and with the move towards auctions, I think it's going in the right direction. And I think that soon we will have greater clarity on the issuance. And I also agree with Pablo that a lot has been accomplished here in a very short period of time. Although, Pablo, I don't think it really is comparable to 30 years. I mean, 30 years ago, you were in kindergarten, you were not running, sovereign bonds, So I'd say maybe 10 years is a good comparison, not 30 years. Yeah.
Thank you, Chris. And so, Vince, how much do you look at the evolving investor base in Euro? We've heard about reserve managers around the world looking more at the Eurozone. We've heard about the appetite from Asian investors, for example, for the NGEU bonds when Niall was talking earlier. Is this something that you follow and plays into your investment approach at all?
Okay, so I won't be in a position to really...
Sorry, Christian.
Sorry.
I'll come back to you in a sec.
Could you give an?
Yeah, sorry. I was just talking about the evolution of the Euro investor base and how much you, as a pension fund based in the Netherlands, follows that. We've seen a lot of public investors globally coming into the Eurozone. Whether that is something you look at, whether that is something that you think will have a longer term impact on euros as a currency addition to the Euro capital markets.
Well, of course, it's we are not looking, intention, but what they are doing. But it's always good that they are entering the European capital markets, because that offers more investor view and also different kind of trading mentality in their portfolio context. But yeah, for us it's fine, but we are more long-term investor, and if we like the investment, we will add in the portfolio. So we are not they are welcome. It's not necessary for us, and as a reserve currency, yeah. I don't have
a couple of basis points here or there, tighter or wider, is not going to have an impact on.
No, that's not having impact. What I said, we are more long-term investor. We are not for the short-term view. Of course, when they are entering the market, we will like to have a fair price. We will not leave basis points on the table. But on the long-term view, basis points, it doesn't matter for us.
Elena, just coming to you as an issuer generally, we've heard maybe the EU should be leaving a little bit more on the table for investors. As an issuer, if you're bringing a bond to the market and its order book is 10 times the size of the deal, would you be tempted to leave a little bit on the table for investors? Would you say, well, the demand is so high, we can pretty much print this where we want?
Well, that's an interesting dilemma, that whoever is actually kind of syndicating a deal and has significantly oversubscribed book. So what exactly your choices are? So you can either increase the size of the bond, but you can increase it only by so much. There are various sort of allocation problems that actually, not problems, actually, there was a nice problems to have for an issuer, of course. But then all sort of conversations that you would need to have with your investor. It's actually interesting. So with regards to IFC, the central banks were our biggest and probably more consistent investor base. So imagine issuing a green bond and having central banks used to having 100% of allocation, and suddenly you're kind of significantly oversubscribed. So you need to have a very interesting conversation. And it's actually interesting that specifically with regards to the green space in particular, where that conversation, the investors become more, I guess, understanding with regards first to the allocation and second of all with the price tightening. There are generally, I guess, first it's a conversation how you market the bond, whether the price at which you're marketing it is perceived to be fair. And as you tighten it, you also want to have a win-win solution both for the issuer and for the investor. So in that regard, each issuer will have different strategy. Do you want to take every single basis point off the table, or you want to sort of have this both issuer and investor walk away from the deal feeling it has been a fair deal for both? So from our perspective, that's what we want to do. I'm hoping that's how our investors feel as well. But in terms of sort of taking every basis point, I mean, in the end, as Seven has mentioned, I mean, to what extent that trade-off between extra basis point versus long-term relationship actually, which one is more important?
Thanks, Elena. Well, there are issues around the reserve status and the green bonds and other things that we'll come to. But actually, we do have sort of like sitting with us some members of the banking community, and we've got into some quite technical questions about how to bring deals to the market, how to price them, and so forth. And I think as they sit between the issue and investor, it'd be just nice to ask them to join the conversation now, give their thoughts, and maybe if they have particular things that they want to ask either the issuers or investors, they could do so as well. So maybe first, as we heard from you earlier, Luca from UniCredit. Luca, if you could just kind of talk a little bit about this issue of where to price, what type of institution is NextGen EU. Agnes's thoughts about the use of mid swaps as a pricing benchmark, and on all of these issues that our group has been discussing now, and where you stand. And obviously, as I say, do please ask a question. Also, just while I'm here, if you do have questions from the audience, do please send them through. We have a lot to get through, but we'd love to hear what you have to say. Luca, over to you quickly.
Thank you, and hi everybody. Okay. It's a very large question, but I'll try to be very brief. First of all, I believe that right now, as usual, market moves, and I use the example of a knife, and normally, the handle of the knives turns is either in the end of the investors or in the end of the issuers. Right now, not only the handle, but the entire everything is in the end. Is in the end of the issuers that may decide a little bit what to do, and we need to follow. I mean, it's not this. Obviously, I'm exaggerating. In terms of the markets, I believe that everybody has benefited from EU. Maybe not Germany, but all the rest of Europe has benefited from the interest that is coming from all over the world. I mean, we've seen Japanese investors into issuers that never seen before. We see relative value hedge funds that were not touching the e-names because of the lack of liquidity. We see Italian investors that used to the return that they have on their BTP, they were not touching e-names at all. Everybody now interested in this. You stole my question to Pablo because obviously I was very much interested in hearing about the new cooperation, and if it's now a cooperation, what until a few years ago, maybe let me say, Pablo, was a little bit of competition, especially from the, let's say, non-core in entering the right market. In terms of pricing, I believe that there is still a long way for EU to become the risk-free reference for Europe, but I believe that again, as you said at the beginning, if this is not temporary, I have a note here that by 26. Looks like EU will be larger in the market than Spain, which is good for Spain because it's going to be take a little bit more because before they become larger than Italy, and it's not a compliment. But the thing that if this is here to stay, and maybe a question for the forum is. The introduction of the future, how far are we from the introduction from the future on EU, will then give a further step and a further boost to the liquidity and the recognition of EU as the risk-free rate for Europe.
So let's ask Pablo to tackle that first, and then we'll ask the rest of the panel. Certainly, obviously, in panel one, the need for a futures market down the line was something that came up.
First of all, thank you, Luca, for those questions. I think we have to, the paradigm's changed. I think we have to move on from debt being a bad thing. On this occasion, Next Generation EU issues debt to invest. So the idea that NGEU is bigger than Spain is a good thing. And it would be better if it were as big as Italy. And it would be even better if it were even bigger than that. So that is where we can, we can progress. This is the safe asset, and it would be more liquid, and all of that debt. None of that is current expenditure. All of that is investment. And so this is Europe investing in itself. The bigger it is, the bigger the investment and the bigger the future growth. Coordination, yes, there might have been a time in which liquidity was perceived as scarce, and opportunities, windows to issue, we might have clashed, etc. But this crisis is not about the availability of liquidity. It's not about central bank policies helping the recovery or helping growth. It's about, this time around, it's different. It's about political economy and how to spend it, rather than being about how the cash is obtained in the market, right? So there is space there for coordination among the different issuers, and that works very well. The times in which we do clash, it is after discussing it. There are many of us, and there is a lot to issue, and the market can cope perfectly well with two large issuers at the same time. But we have to make sure that we both know that we are in the market, and we both are tapping different parts of the curve. So when we do coincide, it is by design and by opportunity and after a dialogue, which 10 years ago might not have happened. So I think it is much better than previously.
Thank you, Bob. Christian, can I just come to you? A couple of things there. One on the futures market and when you think it will come in. I think that's an important point. Secondly, when you do see these enormous order books, is that a good sign, or is that actually a sign that the market's not quite working properly? Is it a sign that people are inflating orders because they know they're going to get cut back? What can we read into these enormously inflated order books at the moment?
Okay, so first on the future, that has to do with the issue of permanence. Right now, from a constitutional point of view, I think we do not have permanence, and it's difficult for the EU to launch a futures program that could be seen as a sort of coup d'etat, which sort of tries to set in motion a deliberation process at the level of the heads of state and government, which hasn't even started yet. So I think first we need to have the constitutional prerequisites, and then we can have a future, unfortunately. Now, with respect to the order books, tough to say to what extent there is inflation here. I can only say, without being able to give names, our growth in asset management is public, and I can tell you that a lot of that is actually coming from Asia. And my sense is we're seeing in this year and in 2020 a fundamental reassessment of Europe from a lot of large and very savvy institutional investors from overseas. I think that for a long time, Europe has traded with a risk premium related to the way the sovereign debt crisis of 2011 has been handled. That led to some scarring, and that is now changing. And I think there is a very strong recognition amongst overseas investors of how this crisis has been dealt with at the European level, the determination and the speed that took place in fighting the coronavirus crisis, and now in putting into place a very ambitious investment program, has become apparent. So I think this is one of the reasons why we have very, very large order books. And I believe that there is a reallocation going on towards some European assets.
Thank you, Chris. And I'm going to now ask Asif Shirani, who's the head of DCM Syndicate EMEA at HSBC, to come in and just tell us a little bit about how those order books are developing, but also maybe could address Agnes's sort of like initial point straight up. Where do you price this? Where do you take your comparisons? And how does one treat NGEU? Asif, over to you.
Yeah, thank you, Clive. And I'd just like to echo the sentiment that Luca passed on as well. It's been a fantastic panel. So I'll probably end up repeating a lot of what's already been said, predominantly by what Pablo has mentioned and what Christian just mentioned. So firstly, in terms of what Christian was mentioning just now, and that feeds into some of the points that Agnes was mentioning, and also the order book sizes that we've seen expand quite dramatically over the context of the last couple of years. So taking a step back, clearly the EU program and what the EU did in terms of tackling the crisis gave this huge boost in terms of confidence to the market. And that has been seen as a very positive turn of events of how the EU has tackled the crisis, to Christian's point. So I think from that perspective, that has drawn in more investors into euros in general and into to EU in particular. And from that, we're seeing a benefit effect to other EGBs. To Pablo's point, that crowding in effect is at play already from our perspective. And we can see this in the stats published post-transactions. When you look at the order book breakdowns or the allocation breakdowns, the percentage to central banks is increasing, the percentage to Asia and international investors is increasing. And just on that point, it also builds upon what Elena was mentioning before, which was the European investor base and their ESG maturity. And clearly that is a competitive advantage that Europe offers versus other currencies and investor pools. The ESG investor base is extremely mature in Europe, and there is a tangible pricing benefit for green bonds as well, as Pablo was able to achieve very recently in his transaction. So again, from that perspective, the green bonds act as this added competitive advantage when it comes to attractiveness of the euro market. And we're seeing that alongside the response for the crisis increase the international role of euros. And it's only as a byproduct of that, we're seeing demand generally increase for order books, for and of course for syndications that we're seeing. Now, we're also, of course, not blind to the fact that the ECB's role during the crisis has also instilled a huge amount of confidence in the market. And because of the ECB purchase program, we've had smooth functioning of the market. And that's also allowed for these order books to grow, as we are seeing faster money also coming into syndications, chasing the ability for some allocations that they can then on-sell into the ECB thereafter at a slight profit. And that in itself is also increasing and leading to that increase in order books. But from a demand perspective, clearly we've seen an internationalization of the euro, and that is definitely a positive step and something that we're seeing hopefully build upon going forward. To Agnes's point, in terms of the view on how EU should be priced, I mean, we don't disagree. It has been questioned whether it's a supra or sovereign. Again, to Pablo's points and to some of the other panelists' points, the fact that we've had this newsletter now published with the NGEU funding, the increase in transparency in terms of the predictability that offers in terms of when the syndications will take place, when the auctions will take place, and not to mention the fact that they can now do bill auctions, which is an added tool in their toolkit, if you will, to ride the storm or to be able to react quicker to market conditions. I think all these things add to the sovereign-like feel of the EU. Doesn't change the question, however, that they have a limited, life in terms of issuance for the moment, as Pablo said. Who knows what happens? And we know Europe's history. If something does work, it does tend to become permanent. And clearly, from a bank's perspective, we're all for that. So let's see how that develops. But to dig a little bit deeper into Agnes's point, every investor will have their own view. What we see is we break down the investor community to different investor types. And we already talked about the increased international distribution and demand within these transactions. But if you look at the domestic demand as well, and you break it down to bank treasuries and then asset managers, insurance pension funds, each of these are acting very differently. Bank treasuries, just to give you an idea, the excess liquidity in the ECB is almost at 4.4 trillion. And that is a huge driver of demand for EU paper, at least up to the 15-year point. And even thereafter, we see bank treasuries coming in. So they form a cornerstone alongside the international community for these transactions. And then you have the asset managers and the pension fund insurance community, the latter of which, as we've already heard from the panel, that are looking to buy this either as a relative value metric, but also from a duration perspective, looking to buy this. And with the limited supply in the long end, the EU at the moment is able to price transactions relatively aggressively when it comes to through the likes of France and Belgium, for example. So all said and done, there's a huge investor base, a growing investor base, and different investors within that investor base that are buying EU debt for different reasons. And I think that's what makes a market, and that's why we've had such a successful outcome for these transactions at the moment.
Thank you, Asif. That's very helpful. Agnes, I wonder whether you could talk to us a little bit about the stock of European debt has been mentioned. I mean, we've talked a lot about liquidity. That even at the end of 2026, NGEU is going to be about 850 billion euros. If you take into account some of the other EU, and we had Team Europe earlier, it's considerably higher than that. But I wondered whether you, as an investor, would look at the Team Europe that we presented on panel one, or whether you would see them as completely different institutions and different buy or sell decisions, or whether that Team Europe thing might take off.
So of course, I would look at the whole of Team Europe. They're not exactly comparable, though. Investors don't put them all in the same sleeve in their funds. So, for example, as was mentioned by Asif, you have those that trade in, absolute value, absolute returns, and relative values. Therefore, there are those that want to hold them, like Sevinch, for example, as a safe asset for the long run. You have, is it a sovereign or supranational? It might become a sovereign, this one, for example, but the next step would be for them to be, for next-gen EU bonds to be included in a sovereign index, and that would make real money have to buy them. So there are several steps along the way, and I think it's super interesting that actually all these bonds have the same story, the same root, the same desire, the same ambition, but they're actually quite a diversified set of instruments that, depending on the strategy that investors follow, they can pick and choose. And of course, fiduciary duty have to maximize risk-adjusted returns. So there are quite a lot of consideration. I don't think the amount is too much. In fact, the amount is great. I'm not even sure that it's going to be a future. That's a question I would have, actually. If no country, if no member states of the EU takes the loan part of the next-gen EU, then probably the program of issuance will have to be less, because the grants are about 450. So there's also this uncertainty about the actual amount of bonds that would be issued there. But no, I'm all for Team Europe and making those products as attractive as possible for European investors.
Thanks, Agnes. I'd like to talk now a little bit about the evolution of the green bond market in Europe. And obviously, in a few weeks' time, we're going to have the NGEU first green bond. It's actually, I think, going to come out just after the UK has done its first green gilt as well. As someone who's just been into the market for the first time, Pablo, so can you talk us through a little bit of what you saw and learned from that process? And obviously, the 60 billion order book was huge. So how did you go about building that, and what might our investors here and other issuers listening in learn from your experience there?
Well, first of all, it's a lot of hard work to issue a green bond. It's not just marketing. You have to comb through and sift through the sovereign budget, and that's no mean feat. And we have to decide which categories of investment have to be assigned to this issuance. And the most important thing is making sure that no one else is funding this amount, at least notionally. And in the presence of Next Generation EU that is going to fund projects within your budget, that limits the amount that you can do. So the 5 billion that we did is smaller than we would have been able to do, precisely because we had to pick and choose the highest prime rib quality product that was available within our budget and that wasn't being funded by someone else. Next Generation EU is a big agent funding stuff within our budget. The regions, Spain is very devolved, and so much of the investment takes place at the regional level. If the regions are funded that way, we can't. And then renewable energy in Spain, the subsidies for renewable energies is funded by a tax, a specific tax, and so if the private sector funds it, the green bond can't, right? So in the end, we identified 13.6 billion to do within the next few years, which is a smallish program, but very, very high quality. So investors know that this is the prime rib stuff that Spain can offer outside of NGEU. So we knew it was going to go very well because it was a very high quality product. It was very, very telegraphed. We've been announcing it for several years. We did the investor presentation in the summer and the reception of that was excellent. And so we knew that we were going to have an allocation problem on our hands. To echo something that's been said before, a syndication is not a feeding. You have to leave some money on the table in order to create a vacuum there in the secondary market for the bond to float. But it's not a deal that you reach with investors that you take this new issue premium in exchange for participating, because there is a lot of oversubscription out here, and it's a very, very complex decision. In the end, we obtained a greenium, which is we priced flat against fair value, and usually we offer two points new issue premium, and this is how we calculate the greenium. Now in the secondary market, that's widened a little bit. So when we tap this bond as regularly as we can, given its size, it should be able to trade through, which is a good advantage, right? It makes it worth the resources that the government spends in making this tailor-made by charging investors for the tailor, put it that way. So it's only natural that it prices through the curve. But it was a very difficult bond to allocate. 2/3 of it went to investors that the syndicate said had green ESG mandates. But that is something that the government bond market, especially, but the capital markets, has to develop. Who is green? Who isn't green? Who is dark green? Who is light green? And that would help enormously the allocation process. But we're happy to say that we diversified investor base, not only because we priced through our curve, and so by revealed preference, we reached investors that could have bought the other stuff, but decided to buy this, right, by revealed preference. We managed to assign much more to Nordic investors than we usually do, and 47% of it went to pension funds, 20% to asset managers, and 10% to central banks, and only, around 7% to Spanish investors. So,
Pablo, let's bring in a pension fund quickly to get their take. Savinj, I don't know whether you were an investor in the Spain green bond, but one of the interesting things that we're seeing already, even before NextGen EU does its first green bond, is the extent to which Euro sovereign green space is becoming a world leader. So it'd be very interesting to get a take from a very big European pension fund on how you see that market developing.
I'm very enthusiastic about it, and it's developing in the right direction because green is in the DNA of the Dutch pension funds. So we are just cheering it. So we are the cheerleaders. If I've said in a very thing way, but it's developing in the right direction because 10 years ago we were just the few investors who were keen to invest in the green space, and developing right. But also they are taking also the pricing aspect also into account, because we always communicate to the syndicate, also to the issuers, that we will not compromise on the pricing. So they are taking it seriously into account, into consideration. We are really happy about that fact, because in the end we are, like what Agnes also mentioned, we have got also a fiduciary duty in order to take also the pricing aspects, the financial return also into consideration next to our social return. So that's also moving in the right. And I would like to add also some final remark, because green bond issue is not the case, but the reporting is also very important, particularly the last 3 weeks when some asset managers were in the news about greenwashing. So the reporting, the data availability is also extremely important next to the issuance of the green development of the green bond markets.
Thank you so much. I think this is a good moment to bring in Marcus Pratt, and many of you will know Marcus. Marcus, of course, is Head of Sustainable Bonds and Finance at DZ Bank. Marcus, listening to what the panel is saying here about the green bond market and the development of the Euro green bond market, something that you're working in every day. Could you share your thoughts with the panel? Obviously, do ask them a question if you would like to.
Yeah, thank you very much, Clive. I mean, I agree with many points of this interesting discussion, especially also the point sovereign versus agency. I would like to focus a little bit on the implications for European borrowing landscape, the redefinition of the European capital markets, and the euro from the sustainable funding. I mean, without doubt, we are entering a kind of new era of EU borrowing, generating not only more liquidity, but also bringing a lot of confidence to investors with regards to the euro. Sustainable borrowing forms the foundation of a kind of, deep, liquid and continuous safe asset for the euro. And the euro could ultimately become a more significant reserve currency in the international financial system. I mean, the current situation, from my point of view, should be seen not only as a historic opportunity for the European Union to build a more sustainable tomorrow rather than rebuilding yesterday, but also redefine capital markets. I mean, we have now to steer financial flows in the right direction. And without doubt, we have no stronger asset than meeting the challenge than our unique single market. And sustainable funding, I mean, whether green or social bonds, is playing a pivotal role in this scenario. I mean, given the volumes, the frequency, the complexity of this fund borrowing, the EU is creating, for the first time from my point of view, a true alternative also to the US Treasury market. And therefore, one can say with clear conscience that the international investor view of the euro is changing. The issuance activity of the European Union will attract more foreign investors to Europe, bolster the international role of the euro, and also demonstrate the cohesiveness and robustness of the euro area. And for more and more central banks, ESG integration is also becoming increasingly important. I mean, some central banks already have included green bonds in their asset purchase programs. And let's not forget, already today, the euro is one of the most sought and most used currency in the global sustainable bond market. In 2020, for example, it accounted for 48% of global issuance, and the US dollar was only 28%. So there is immense potential from my point of view to grow, because the sustainable transition from my point of view is still in its infancy. We are still at the beginning of this sustainable transformation. And with a pan-European reach, sustainable markets could also help other countries to access the capital they need to finance their transition. And this is not true for only those with the most advanced markets. And it has a positive signaling effect on other parts of the world. I mean, sustainability knows no borders. All economic, ecological, and social challenges affect us all. And this is why the mobilization of private capital must also know no borders from my point of view. So at the end of the day, the sustainable transition offers us the historic opportunity to build a truly European capital market and to build a truly international capital market. Yeah, this could serve as a reference point for others and bring us a sense of coherence for continuing efforts to develop sustainable finance around the globe.
Thank you, Marcus. We're getting down to our last 10 minutes, so I'm going to ask everyone to keep their comments reasonably short now, so we can put a little bit more in. Elena, just listening to that, though, that development of the euro capital markets as maybe the leading capital market for green bonds. How will that impact what you might do in terms of your issuance strategy? You mentioned earlier that you're certainly looking at potential green euro bonds in the future.
Well, that's actually interesting with regards to green, and if I sort of expand it more towards social sustainability and the whole kind of lifting up to the whole conversation about ESG. As I have mentioned, we generally finance projects outside of the EU. It's mostly in the developing emerging markets. But we do issue and European investors do buy IFC bonds. So whether we're talking about the green bonds, the social bonds, or general one, what we have had experience that on the back of EU regulations, the green bond standard and the taxonomy, we had to respond to the inquiries from the European investors with regards to how we are aligned, specifically the green, but even broadly our funding program. So this is something that every issuer that actually selling the bonds to European investors will have to answer. So we ourselves also had to consult with various teams internally with regards to how we align with the EU taxonomy. We had to rely on expertise of our climate business and financial institution groups, the groups that are actually involved in the developing national green and sustainable taxonomies in emerging markets. So our main takeaway from the investors is that IFC supports the taxonomy and it would aims to do, and our green bonds generally finance activities that contribute to all 6 of the EU environmental objectives. Taking it sort of more further, and I guess in stepping more into kind of piggybacking on what Marcus has mentioned, this is as much of a progress has been made, this is still a nascent market. It's still in its infancy, and it does require quite a lot of investments. There is quite a lot of challenges, in particular, probably for the asset managers. You're dealing with, we're still working on a lot of definitions. It lacks some of the reporting standards for the company. You deal with incomplete data sets. And there is quite a lot of temptation as we're listening on the back of huge investor demand for the green bonds, that some folks may look at it, okay, this is a great marketing opportunity. We can create some interesting products. There is a great investor demand. And, but that sort of potential greenwashing can create a lot of cynicism around it, and did create quite a lot of cynicism. So then we start talking about the reporting, and I guess I read it recently and I love that expression. The issues need to be really authentic. They need to be really honest about what their programs aim to achieve, actually, and where they're lacking, where there is still work to do. It's very harmful for the ESG investing and issuance when you cross the line into misrepresentation. And in that regard, supranationals like IFC, we try to kind of be the leader, kind of create the templates of how the reporting needs to be done, how disclosures need to be done.
Elena, thank you for that. I'm conscious of the time because I really want to bring Christian in here, because I know this is something that Christian has strong views on. So Christian, sorry for coming to you last on this topic, but I know you have some strong views on this that you would like to share, and it'd be interesting to hear what you think of that. Other panelists have said as well on the subject.
Yep, thank you. So I'm going to say something slightly controversial here, just so that everyone is on the same page. There were 2 major developments over the summer. On the 6th of July, 2021, the European Commission has published a proposal for a EU green bond standard, which means that the use of proceeds need to be taxonomy aligned. And then on the 7th of September, 2021, the European Commission, DG Budget, has issued the EU green bond framework, So there's the standard and there's the framework. Two things, two distinct things. Yeah. Now the bonds that are being issued, right, the first green bond that will come to market in October will be issued under the EU green bond framework, and that framework is fully compliant with the ICMA framework, and that is basically what has been used to build the green bond market, which is set to exceed 1 trillion euros at the end of 2022. It will exceed 1 trillion euros of European issuers in 2024, and we see it rising massively in the years ahead. So the entire green bond market is built on the ICMA standards. Yeah, it is not built on the EU green bond standard, and it is not taxonomy aligned. Yeah, and I have a slightly different perspective here from Elena. Just to say, I've been at a meeting with Mark Carney last week, and he put it in just one sentence: "It's the transition, stupid." Yeah. So we are facing a monumental change in the way our societies are built, our economy is built. We're basically facing an undoing of 250 years of industrial revolution and the way we've been treating nature in this period. And we have at most 25 years to change that and to move towards carbon neutrality. Yeah, a very big challenge that lies ahead of us, and that will require all sectors of the economy to transform and to move forward. So the key role of the green bond market and the key role of finance in general is to fund transition. Yeah. Now, every day we're confronted with a journalist who calls us up and says, "Well, there is another example of greenwashing here and there." And we've been designing our new sustainable products over the course of the last year. And some people were saying, well, you should do a best-in-class approach, only invest in the top 20% of every single industry, leave out 70, 80% of every industry. I think this is fundamentally wrong. Yeah, we need to put money where it is needed. And we have to stop just investing in, the Uber green projects, which are already full of funding. Yeah, we need to put money into the cement manufacturers. We need to put money into the steel mills. Yeah, and we need to put money into the chemical industry. And we need to put money into the grids. We need to put money into all aspects of our society and of our economy in order to allow for green transformation. Now, if we're trying to do this on the basis of an extremely rigid EU taxonomy, yeah, which basically rules out investments in almost anything you can think of, yeah, it is not going to happen. Yeah. So therefore, I think we have to be very cognizant of the risks involved in all this greenwashing debate, and we should concentrate on funding credible transition towards sustainability. If we see, for example, if you look at the EU proposal, if we have a company that reduces its CO2 footprint every year by 7%, and if that company, is in the top half of its industry, that should be eligible. Yeah, even if the current CO2 footprint is very high. Yeah, so just leaving out everyone, for example, we were looking at a windmill producer, and we were trying to classify the business activities of that windmill producer. Turns out that 6% of that company's turnover is EU taxonomy aligned. Yeah, that's a joke. Yeah, so I think the taxonomy is too rigid. Yeah, and it does not focus enough on the dynamic needs for economic transformation and transition. And that's what we need to focus on.
Christian, thank you for that. It's a really important point that you make, and unfortunately we are running out of time. It's a point I think that will continue to be made next week at OMFIF's Sustainable Policy Institute Symposium that's taking place next week over 2 days, which I encourage all our speakers and all our listeners to tune into as well. We're running out of time now, so I'm sorry to those that asked questions towards the end of the panel that we couldn't bring to you. Today has been a really fascinating series of conversations on a really fascinating market. I think we wait to see in terms of euro as a safe asset. I think we all probably sense that it will continue to issue after 2026, and that will help bring the substance to the market that's needed for that. There are issues still to be faced and still to be talked about and solved. OMFIF will hopefully continue to be part of that conversation. My main job now is to thank those of you for taking part in this panel. Thank you to all of my panelists. Thanks to those in Team Europe and the banks that took part in panel one. Thank you for Thomas Wiese for his thoughts at the start of the day. We look very much forward to continuing this discussion, which we will do in a couple of weeks' time with our Central and Eastern European DMO Forum on October the 5th. And then we have a session on October the 11th about the the introduction of the green gilt and what that means for the green sterling market in the future. Please join us for those. But just as I wrap up, I wanted to go just for a final word on the day to the Deputy Chairman of OMFIS Advisory Council and the Global Head of Banking at DZ Bank, Frank Scheiding, who has been a follower of the Euro markets development for many, many years. And Frank, over to you for the final words today, and thank you again, everyone, for attending.